Hello and welcome to our weekly look ahead at the markets. Obviously in the last week we saw the European Central Bank raise rates by 25 basis points. They're taking the deposit rate to a record high 4%. It's raised rates cumulative 450 basis points over the last year or so, and the market is now guessing as to what happens next. The ECB suggested that it's going to stop for now. It seems that it's done. It thinks it's sufficiently restrictive. It's left the door, a tiny crack in the door for potential for another hike or two later down the line. But for now, it thinks that it's more than ample to bring down inflation. Some of the hawks on the ECB were out immediately afterwards. They were saying that if wages continue to creep up and inflation remains a bit too sticky, then there could be a hike in December. But I think that would be tricky for those hawks to swing it with the rest of the Governing Council. In fact, a small minority last week actually preferred to pause rather than do that last hike. So the market now is guessing on whether central banks are done, how much tightening is left, if any at all. And so that leads us neatly on to this week and the Federal Reserve, which is the big one, of course, and then the Bank of England coming up as well. First up to the Fed. Now, it's odds on to pause. We think that it's done for now. The market pricing in just a roughly 5% chance that it hikes in September, but it's still about 1 in 3 that it goes for one more in November. So it's more of a skip, seems to be the idea among many. So we're looking to see, not really on the decision, because we think the main decision will be to pause. The key will be the dot plot. So we get fresh economic forecasts from policymakers. These dot plots which signal where they think interest rates are going to be over the next 3 years or so. Now those numbers suggested back in June, with the last dot plot that we got, they suggested that the median federal funds rate would be 5.6%. Now, at the moment, it's between the target range is between 5.25 and 5.5%. So that dot plot indicates that there's just a slight bias towards another hike, and so the market is pricing for roughly 1 in 3 chance of a hike in November, and that seems maybe about right based on the dots. The key will be, what do they think now? Where do they revise those dots to, if at all? So we think potentially that they're going to revise them down, that they're going to say actually 5.5 is where we think rates will be this year. Now that would be a clear and unambiguous signal to the market that they're not going to hike in November. Otherwise, if they leave them unchanged, there'll be still that sense that maybe there's going to be a hike. And again, it's just looking at these inflation numbers. Last week we saw US inflation just ticking up. PPI also quite hot, retail sales firm as well, although a lot of the headline inflation, a lot of the headline retail sales numbers is down to higher gasoline prices, and though that does feed into higher headline inflation, it's really the core number that the Fed is looking at, and that core number seems to be moving broadly in the right direction. So the Fed expected to pause. The question really for the dollar, where it heads from now, where treasury yields go, is to do with the dots for November, but also the dots further out into 24 and 25, and that sort of message about higher for longer, and just how much the Fed is going to stick to its guns on that, and whether the market starts to push back on when it thinks the Fed might cut. Meanwhile, on Thursday, it's the time for the Bank of England, and we think maybe one more hike. Again, probably similar to the ECB. It's in this sort of similar position. It's in this sort of stagflationary kind of environment. Anemic growth, inflation still too high, it's hiking into recession, and it's going to have to maintain rates higher for longer anyway, because inflation is not going away. So sort of stagflationary environment for the Bank of England, and I think probably one and done will be the signal. Hugh Pill, the chief economist, has been out recently talking about preferring to keep rates on a sort of plateau, higher for longer, rather than peaking and then cutting. That seems to be the mood among the central bankers generally, and I think maybe there's room for one more from the Bank of England in the coming week as well. Elsewhere, there's all the usual data to look out for. Check the weekly unemployment claims data from the US. That'll be one to watch. Bank of America out with a note actually on Friday, the flow show, just commenting there's about 7 key swing states where they're paying close attention to those unemployment claims numbers as it might affect the election next year. You know, it's the economy stupid is the sort of mantra there. And then, of course, weekly crude oil inventories will be one to watch as well, because we've seen crude oil prices spiking above $90 on front month WTI, so that's something to keep an eye on. Treasury yields, they were trading about 4.3% on the 10-year, above 5% on the 2-year on Friday, looking to see whether there's sort of a mood to break out of that sort of peak. Last week we saw the FTSE post its best week in a while, amid higher oil prices and also commodity prices, which came back towards the later end of the week as Chinese data overnight on Friday was stronger than expected. You had that good retail sales number in particular. So lots to look out for in the coming week, but really chiefly we're looking at the Fed, the Bank of England, and not least of all as well the Bank of Japan. Not expecting anything major from them, but there is always scope for a surprise with the new governor, Umida, who is apt to announce things off the cuff. So keep your eyes on that Bank of Japan as well, but main things to look out for: the Fed, the Bank of England this week. Thanks for watching.